Welcome back to FT Markets. The lights are burning late in the European Central Bank's new headquarters building in Frankfurt. Mario Draghi, ECB President, will this week set the stage for the launch of Eurozone quantitative easing. Prospect of a big buyer has sent Eurozone bond prices sharply higher and yields lower. With me to discuss what happens next is Nick Gartside, who's Chief Investment Officer for Fixed Income at JPMorgan Asset Management. Nick, welcome to the Financial Times. Now, the experience of QE in US, of course, was that once it was actually launched, yields went up again on expectations of growth and inflation. But there's a big difference, of course, here in the Eurozone. Can you just explain what that is?
Yeah, so the key difference when you look at the Eurozone is the supply picture.
You brought a nice chart to illustrate this.
And when you look at that supply picture in the Eurozone, what you've got is net negative supply, i.e. you've got the ECB buying more bonds than will be issued this year.
This is because governments are retrenching fiscally. We're not in those years of massive government deficits anymore.
No, that's right. So what you create here is that supply-demand imbalance in a very similar way to Japan.
If we look at the chart, actually, overall, ECB purchases, this is projected over the lifetime of the QE programme, substantially in excess of the net supply, but the imbalance particularly acute in Germany.
No, it is. And when you look at Germany, you've already got negative yields out to about 7 years, and the risk, of course, is you get more negative yields there.
Yeah, in fact, if we look at our second chart, we've shown we looked here at just the 5 year. You say German 6 years are negative as well, 6 and 7. But actually, just looking at the 5 year bond yields, they're negative now. Austria, Luxembourg, Netherlands, France, not far off there either. Do you really think those yields can go even lower?
Definitely. When you look at the Eurozone government bond market, you've got about 25% of all government bonds with a negative yield. In our view, that will grow. And part of that is that supply-demand imbalance. And what you will also see here is a grab for yield on those markets that do offer yield.
These are, we look at Spain and Italy, also at historic lows, but compared to Germany, they're still in positive territory as well. Therefore, you think people are going to be buying Italy and Spain?
Very much so. When you look at Italy and Spain, they're in much better shape than they ever were before. And
so the risk of them going belly up, or default risk, is incredibly low.
Default risks are very, very low. You've got much better banks, much better government finances. You've arguably got a ratings dynamic where they'll be upgraded, not downgraded.
Yeah, if we look at how Spanish, Italian and Portuguese bonds have performed over the past few years, they've come down substantially already since the crisis, the Eurozone crisis 11-12. Are you really saying that rally can carry on even further towards the zero bound?
Very much so. And one thing that maybe we should do is extend this chart. If we'd looked at that chart since 2000, think where bond yields were then. So when you look at Italy, when you look at Spain, our view is that those bond yields contract by at least another 0.5% from current levels.
And of course, what we could also have shown, but we haven't, a bit complicated, is showing that the difference over German yields is narrowing all the time.
It is, and that contracts 0.5 to, if not 0.75% from current levels. And we're in that environment, and QE encourages this, where you get that grab for yield.
So if the ECB is going to tempt JPMorgan Asset Management to sell its Spanish and Italian bonds, are you ready to sell them?
We're not. It's a question of valuation. And in our view, those yields go down, those prices go up quite a lot more.
So the ECB is going to have to be quite aggressive to meet its targets.
The ECB will. And also remember, a lot of those bonds are owned by banks. And of course, banks have to own a lot of government bonds for capital reasons. So who will be the seller is the key question. And maybe that seller emerges when yields are a lot lower from current levels.
Nick, we're going to have to stop there. Thank you very much. So projection there that yields could fall even further, including for Italian and Spanish bonds as the ECB launches QE.